Today, we're going to tell you how you as an employer can save your employees, particularly your key executives, on taxes while filling the biggest hole they have in their retirement plan.
That's right, Shannon. Something that most companies don't realize is that they can provide long-term care insurance to their employees on a tax-free basis. And if they're a taxable organization, they get a deduction. Even if they're a pass-through or subchapter S or a partnership, as long as that employee is not more than a 2% owner, they can actually provide this benefit, long-term care benefit, to the employee, and it's not taxable to them.
That's right. So you might be thinking, why does anybody care about long-term care insurance? What is it? Long-term care is actually something that's not covered by Medicare. So even if your employees have done a great job of planning for retirement and maybe even have planned for healthcare costs in retirement, none of that really covers their long-term care issue. When you lose 2 or more activities of daily living, basic things like bathing, dressing, getting around the house, and once you lose the ability to do 2 of those things, that's when you're eligible to receive long-term care help. That might come in the form of having to go to a nursing home, which a lot of us don't like to think about later on in life. Or it might be something as simple as somebody coming into the house and helping you out a couple times a week. One of the reasons that long-term care insurance can be beneficial is because these costs can be extremely expensive. In 2019, I think the average cost to stay in a nursing home for a year is around $100,000, and that's 2019. So if you've got employees that are a long ways out from retirement, just think of what those costs are going to be 10, 20, 30 years from now. They're only going to go up, they're only going to get worse, and again, they're not covered by Medicare or any type of health insurance. So employees need a plan. Now, Michael, let's talk in a little bit more depth about the tax benefits and why it's good for not only the employee, but for the employer.
The nice thing about the employer paying for this is that, again, it's not included in taxable income to that employee. So if the employer were going to, let's say, bonus them that amount, the employee would have to pay FICA taxes. They would have to pay state and federal taxes. In this situation, because they're providing it, they're not paying FICA on it, they're not paying state and federal taxes. So it's a huge savings. I mean, even for a lower income employee, we're still probably talking about 30-35%. But for your higher income employees, it can reach, depending on what state you're in, you have city taxes. I mean, places like New York and LA, I mean, we're talking 50% tax rates for some of your executives.
Yeah, not to mention later on in life, should they need long-term care help, you want them to have a way to get access to dollars that are tax-free, because if they have to spend post-tax dollars on long-term care, it's going to cost them a lot more than it is maybe a counterpart that is in those lower income ranges.
That's right, Shannon. When you're retired, a lot of people can take advantage of the medical expense deduction when they have tremendous long-term care costs, but you still lose 10% of whatever those costs are, because the government basically says you can only deduct expenses above 10% of your adjusted gross income. So, if you had a $100,000 expense and you're able to deduct $90,000 of it, you still have a $10,000 expense that you're having to pay. So that's the first thing. Secondly, if you look at the odds for a 65-year-old couple, there's a 60 to 70% chance that one of those individuals will need some type of care. One of the products that we are going to talk about today actually allows you to insure both you and your spouse.
Yeah.
So that you can use the benefit for either of you, or if one of you runs through your full benefit, there's actually a third benefit that can be shared with your spouse, so that you can have additional dollars to cover. And that's going to be impacted when somebody might have a cognitive impairment. And they're, needing care for 5 or 10 years, which we've seen. While it may be rare, it's, I know a number of cases where people have been in a nursing home for 10 years or longer, or they've been home for 10 years or longer with some sort of a cognitive impairment.
Right, and in that scenario, it's not always later on in life. It can happen anytime. People are starting to get things like Alzheimer's Alzheimer's and dementia younger and younger, and it's becoming more frequent. So one of the things that you had mentioned that we think you should always take into account when you're looking for the right type of policy is that flexibility for both the employee and the spouse, if they are married, to be able to kind of share those costs, or each one of them dip in, and then have the flexibility where both people can get coverage at different points in life if needed.
That's right. Now, we'll see a lot of advisors. You see them on TV, some of the named advisors, where they don't necessarily believe in long-term care insurance, especially if you're a higher income or you have enough assets that you might be able to pay for those costs out of pocket. Mm-hmm. Well, we're not big believers in that, especially when you have a pocketbook of a company to take advantage of that. Mm-hmm. So why wouldn't you use a vehicle that is going to pay for those costs that you're actually getting a deduction on, you're not having to pay income on? That's the first thing. And then secondly, this particular policy that we look at has a return of premium and a death benefit attached to it that you can purchase. So this way, because that's been the second thing where a lot of people are concerned, well, what if I don't use it? Now, we just gave you the 60-70% number, which we think most people are going to use some level of, or need some level of care, one of the two spouses. But if you don't, then this particular policy can incorporate a death benefit where your heirs will get all of the money that you paid back when both you and your spouse pass away.
Whatever happens, the policy will be put to use in some way or another.
That's exactly right. Another key feature of this particular product is it can be paid a 1 year. So you can make a premium one time, you can do a 10 pay, or you can do a life pay. So for a lot of companies that we're working with, they're looking at doing either one pays for executives that are getting close to retirement, or they're doing 10 pays so that employee, when they get to retirement, they have no more costs as far as long-term care premiums go. And they've been able to fill that hole of their retirement plan.
Yeah. And Michael, a quick question for you. So at what time in life do you think is the appropriate time to get long-term care insurance? And if you're an employer, at what point is the most appropriate time? And how do you know when to do a 10 pay versus a lump sum payment?
Yeah, great questions, Shannon. So age 40 is where most of these policies start. So that would be kind of the starting point. You have to always remember about insurance. Everyone tends to forget about the fact that they're underwritten, meaning you have to actually answer health questions and be in good health to qualify for a lot of these plans. Mm-hmm. So, I think the healthier you are, the younger you are, if you're in your 40s or 50s, it's always a good time. Again, using that corporate pocketbook to help you save taxes. If you look for your higher income earners, the ones over $400,000, the Biden tax plan at least is looking at basically going back and adding the Social Security tax to those incomes over $400,000. Well, that's 12.4%. So, if you can put a benefit like this in to help reduce some of those incomes and still, again, provide that executive or key person the long-term care benefit, we think that can work really well. But I would say, most people we're seeing 45 to 50 is the starting point.
Yeah, kind of the sweet spot. But that's not to say that you can't get it when you are a little bit older. So the best thing to do if you're interested is to talk to a professional, figure out, are you going to even be able to get coverage? And if so, what does that look like?
Yeah, just to give you one example, we had a 65-year-old executive that was basically going to have a year's severance when they retired, and they went ahead and took that severance and purchased the policy for the executive. Mm-hmm. And then they ended up not having to pay tax on those dollars, and they got the benefit that really basically plugged that, as we said, plugged that hole that was there in their retirement plan should something happen to one of them.
Yeah. And one more thing that I want to point out, we've gone over the financial benefits of doing something like this for your key executives. But the other piece that we do want to touch on is the peace of mind. Nobody ever wants to talk about, well, what happens when I get older? What happens if I get sick? What happens if I have to end up in a nursing home? And the reality is this is something that they will eventually have to think about. So if you can kind of take that piece off the table of, what happens if, and solve a problem that They may otherwise have had to dip into other retirement savings or rely on a spouse or a child more than they really feel comfortable with. We think that's a great thing if you can kind of come in and help them solve that problem and just kind of have it be something that you don't have to worry about.
Well, and Shan, I can tell you firsthand out of experience, when my mother had a long-term care event. Fortunately, she recovered from it and never really had to use the coverage. But that was one of the things we had to think about was, okay, which assets are we going to sell to be able to cover the costs?
If your retirement is in the market, what happened in 2008 when people all of a sudden needed access to money and they had to take it out and ended up either not having enough to cover it or just taking a big hit when the time came that they needed the cash.
That's right. I mean, you have that downside risk. So this is a really simple way to let your family know, for you to know that you've got that coverage. And as an employer, you really are helping solve a problem that most people do not have an answer for if it should happen to them.
So if you're curious on how much long-term care might cost you in the future, we actually have a report that we've put together that's totally customizable. You can find it in our description below. And it will not only give you some estimates on what long-term care might look like for you from a cost perspective down the line, but it'll also show you what your healthcare expenses in terms of Medicare will look like and how that'll impact your Social Security. It only takes a couple minutes to answer some questions, and then it's a pretty comprehensive report that you'll get via email afterwards. If you are an employer and you want to learn more about how you can implement long-term care policies for some of your key executives, feel free to contact us and we're happy to help you walk through it, or we can also answer any questions you might have in the comments below. We're Shannon and Michael, and we are always here to help. Make sure you subscribe to our channel if you haven't already, and click the notification bell so you know when we come out with new videos.